Hello humans, welcome back to Finance for Teens. In today's video, we'll be talking about the sideways movement of the stock market and what you should do when the market moves up and down in a range. When we talk about the stock market, we often hear about the price going up or down. However, there is also another type of movement that can occur known as sideways movement or consolidation. Sideways movement happens when the price of a particular stock or the overall stock market remains relatively stable for a period of time, typically oscillating within a range between two support and resistance levels. This range-bound price action can be frustrating for investors, as it can seem like the market is not making any progress. However, sideways movement is a natural part of the stock market cycle and can offer opportunities for investors to buy and sell stocks at a good prices. Understanding the mechanics of sideways movement, including how to identify it, how long it can last, and how to navigate it, can be crucial for making informed investment decisions. Quick disclaimer: this video is intended for educational purposes only and does not constitute any investment advice. Please consult your financial advisor before making any investment decision. Now let's talk about the different phases of the stock market cycle. The stock market goes through different phases over time, and understanding these phases is important for investors who want to make informed decisions. While different sources may be defined the phases slightly differently, they typically include the following points. First one is accumulation phase. This is the early stage of a market cycle where prices are low and investors are starting to buy stocks. There is often little public interest in the market at this stage. Second one is markup phase. As more investors buy into the market, prices start to rise in what is known as markup phase. This is often a period of strong economic growth and increasing confidence. The third one is distribution phase. When prices reach their peak, the market enters the distribution phase. This is a time when some investors may start to sell off their holdings as they believe that the market has reached its maximum value. Fourth one is markdown phase. As selling pressures increase, prices start to decline in the markdown phase. This can be a difficult time for investors who have purchased stocks at high prices. Fifth one is consolidation phase. Eventually, the market reaches a bottom, and this is where the consolidation phase begins. During this phase, prices trade with a narrow range as the market takes a breather before the next cycle begins. Understanding the different phases of the stock market cycle, including the consolidation phase, is important for investors who want to make informed investment decisions. By recognizing where the market is in its cycle, investors can adjust their strategies accordingly and make the most of the opportunities that arise. Now we will talk about understanding support and resistance levels and how they impact the stock market. Support and resistance levels are key technical indicators that help investors understand the range of prices within which a particular stock or overall stock market is trading. First point is support level. Support level is the price point at which there is a significant amount of demand for a stock, meaning that many investors are willing to buy the stock at that price. This demand tends to prevent the stock from falling further, hence the term support. Second is resistance level. Resistance level, on other hand, is the price point at which there is a significant amount of supply for a stock, meaning that many investors are willing to sell the stock at that price. This supply tends to prevent the stock from rising further, hence the term resistance. This support and resistance level create a range within which the stock or market is trading, and this range can be used by investors to identify potential buy and sell points. For instance, an investor may consider buying a stock when it reaches the support level, as it is considered to be undervalued, and selling when it reaches the resistance level, as it is considered to be overvalued. However, it's important to note that support and resistance levels are not foolproof and that the market can break through them on occasions. In such cases, the support level may become resistance and the resistance level may become support, and the investors need to be prepared to adjust their strategies accordingly. Now, let's talk about how to identify when the stock market is in a sideways movement phase. Identifying when the stock market is in a sideways movement phase can be challenging, but there are 5 most important indicators that can be used to identify this phase. The first thing is to look for is the absence of a clear trend in the stock market. In a sideways movement phase, the stock market is moving within a range, with prices oscillating between a support level and a resistance level. This means that the market is not making significant moves up or down, but rather is moving sideways. Second indicator is trading volume. During a sideways movement phase, trading volume is often lower than during a trend. This is because there is less momentum in the market and investors are hesitant to make big moves. Third, technical analysis can also be helpful in identifying sideways movement phases. You can use technical indicators such as Bollinger Bands, moving averages, relative strength index, that is RSI, to analyze price movements and identify periods of consolidation. Fourth, you can also look at the news and economic indicators which help you identify sideways movement phases. During periods of consolidation, there may be little news or market moving events that are impacting in the stock market. Economic indicators may also show little movement, indicating that the economy is in a stable phase. Fifth, check whether the Nifty is in the fear zone or greed zone. You can find the Nifty PE ratio on financial news websites such as Money Control or Economic Times, or on the NSE website. If the Nifty PE ratio is above its long-term average, which is around 80 to 20, it indicates that the market is in the greed zone. This means that investors are willing to pay a higher price for stocks, anticipating that the market will continue to perform well in the future. On the other hand, if the Nifty PE ratio is below its long-term average, it indicates that the market is in the fear zone. This means that investors are hesitant to invest in the market and are not willing to pay high price for stocks. Now coming into the strategies for investing during sideways movement phases. When the stock market is moving sideways, it's important to have a strategy for investing that takes advantage of this range-bound price action. One popular strategy is to buy stocks near the support level and sell them near the resistance level. The support level is the price point at which demand for a stock is strong enough to prevent it from falling further. This level is often viewed as a good buying opportunity because it represents a price point where buyers are willing to step in and purchases the stock, potentially leading to a rebound in price. By buying near the support level, investors can potentially get in at a good price and benefit from any subsequent upward movement in the stock's price. Conversely, the resistance level is the price point at which supply for a stock is strong enough to prevent it from rising further. This level is often viewed as a good selling opportunity because it represents a price point where sellers are likely to step in and unload their positions, potentially leading to a decrease in price. By selling near the resistance level, investors can potentially lock in profits and avoid any subsequent downward movement in the stock's price. It's important to note, however, that investing during sideways movement phases can be risky, as there is no guarantee that the stock will continue to oscillate within the same range. Investors should always conduct thorough research and analysis before making any investment decisions, and avoid taking on too much risk during sideways movement phases. Now coming into the how to avoid impulsive decisions during a sideways movement phase. Sideways movement in the stock market can be frustrating for investors, as it can feel like there's no clear direction or momentum. During these periods, it's important to avoid making impulsive decisions that could harm your investments. One way to avoid impulsive decisions is to stick to your investment plan. If you have a well thought out strategy in place with clear goals and diversified portfolio, then it's easier to resist the urge to make impulsive trades based on short-term fluctuations in the market. Another way to avoid impulsive decisions is to keep an eye on your emotions. It's natural to feel anxious or impatient during sideways movement, but letting those emotions drive your investment decisions can be lead to costly mistakes. Take a step back, breathe, and remind yourself of your long-term investment goals. Finally, it's important to stay informed and educated about the market during sideways movement. Keep up with financial news and market trends, but don't let them dictate your investment decisions. Stay focused on your own strategy and investment goals. The potential catalysts for a breakout from a sideways movement phase. While sideways movement in the stock market can persist for a while, it's important to keep an eye out for potential catalysts that could cause a breakout from this range-bound trading. These catalysts can come in many forms, such as economic indicators or company news. For example, positive economic indicators like rising GDP or low unemployment rates could provide a boost to the market and lead to a breakout. Similarly, company-specific news such as new product launch, successful earning reports, or merger or acquisition, buyback announcement, dividend declaration could cause a stock to break out of its consolidation phase. Suppose a company just announced good financial results, and as a result, investors are optimistic about the company's future. This positive sentiment leads to an increase in demand for the company's stock, as investors want to buy the stock before the price goes up. At the same time, if there are a limited number of sellers willing to sell the stock at current market price, this creates a supply shortage. As a result, the trading volume of the stock is likely to increase as investors compete to buy the limited available shares. On the other hand, if a company announces disappointing financial results, investors may become pessimistic about the company's future, leading to a decrease in demand for the stock. If there are more sellers than buyers willing to sell the stock at the current market price, this creates a supply surplus. As a result, the trading volume of the stock is likely to decrease as investors are not interested in buying the stock at the current price. It's important to note that these catalysts can work both ways, meaning negative economic indicators or company news can also cause a stock or the market as a whole to break out to the downside. Therefore, it's important for investors to stay informed about the latest economic and company news and how it could impact their investment. So, coming to the conclusion, we can say no one can predict the future with certainty. Keeping an eye out for potential catalysts can help investors to be prepared for a breakout and adjust their investment strategy accordingly. If you like this video, feel free to like, share, subscribe to our channel and press the bell icon for more informative content. Till then, bye bye and see you in the next one.